You're watching today's market comment here at xm.com by Mario Sajikiriakos. I'm Christina Marucos. Another stormy week for global markets comes to an end as investors continue to grapple with a range of risk factors, from a lukewarm earnings season to the heightened volatility in bond markets to the unfolding geopolitical crisis. On the bright side, economic growth in the United States clocked in at 4.9% in annualized terms in the third quarter, easily surpassing forecasts. Despite the overall encouraging GDP report, the dollar was unable to rally, as the implied probability for future Fed rate hikes declined somewhat, and U.S. yields retreated once the dust settled. However, the dollar currently enjoys the strongest economic growth among the major economies and offers the highest real yields, a combination that can keep the reserve currency supported, especially when considering its safe haven qualities and the lack of any attractive alternatives in the FX arena. Wall Street suffered more damage yesterday and is headed for losses of almost 2% this week. In a surprising twist, mega-cap tech shares are leading the way lower this time following some disappointing earnings reports, which alongside sky-high yields have started to put pressure on stretched equity valuations. It seems that investors are increasingly taking profits instead of chasing further returns, likely concerned about a deteriorating global macro environment, putting the brakes on earnings growth next year. Crossing into Europe, the European Central Bank left interest rates untouched yesterday and signaled it will likely remain sidelined for some time, allowing high rates to work through the economy. President Lagarde highlighted the slowdown in economic growth, but didn't sound too concerned about an imminent recession. Euro-dollar was relatively stable on the European Central Bank decision and U.S. data releases, closing the session little changed. In the geopolitical sphere, tensions continue to escalate after the United States carried out airstrikes against Iran-backed targets in Syria in retaliation to a series of attacks against U.S. military personnel stationed in the Middle East since the Israel-Hamas conflict began. Gold and oil prices moved higher in the aftermath as these instruments have served as barometers for geopolitical market stress this month. Gold also received a boost from the retreat in real yields, although the $1,985 region continues to block any advances. The question is whether Iran will somehow be dragged into this conflict, and if that does not happen, then safe haven demand for gold might begin to evaporate. This was today's market comment here at xm.com. Have a great weekend.